Talking about joining us now is Mike Santoli with more on what the bond market is signaling. Gabriela Santos, global market strategist at JP Morgan Funds, is here also. She's going to tell us what to do with all of our investments, right? Gabriela?
That's right.
Okay. And Paul's going to help with that. Paul Hickey, co-founder of Bespoke Investment Group. Our guest host, Joe Terranova, is here as well, senior managing director at Virtus Investment Partners, as well as a CNBC contributor. What did you hear Joe earlier saying? Don't worry about it.
I'm not sure he said don't worry about it, but I agree with Joe, and I've been trying to make that point as well, that these macro factors, first it was the Chinese currency tipping above 7, and now it's the yield curve. We've loosened the sensitivity to it in the stock market. I don't think you can say, we figured it out, it's fixed, we're setting it aside, but I do think it's not a switch that gets flipped when you have this inversion. On the other hand, as Becky alludes, the history of saying the yield curve isn't forecasting anything this time is not particularly illustrious, because in the mid-2000s, people were also saying that because of a global savings. But I think it just tells us what we sort of already know. We have a scarcity of yield in the world. Deflation seems like a bigger risk than inflation. And the markets are saying the Fed is too tight given the global interest rate structure and is anticipating cuts.
One thing we definitely don't ever want to do here is sort of instill complacency to a great extent either, though.
Right.
There are some people, like Wilson was on yesterday, Mike Wilson, saying it's staring you right in the face.
Right.
What's happening in the bond market is staring you right in the face in terms of a global slowdown.
But he's speaking specifically to the ability of the S&P 500 to continue to move higher and eventually take out the highs. We're talking more about the construction of a portfolio, looking at other asset classes, looking at credit conditions, which I would argue are very strong, looking at the consumer, which when we get that personal consumption is going to come in very strong once again. So to me, the dollar is the conversation. That's a tightening mechanism. And as I said to you before, as long as that remains
Wilson's
high,
talking more about an earnings recession, maybe not a recession of back-to-back
coming off
quarters
plus 20% last year, yes.
2%. But he's, instead of being at 180 for 2020, his bear scenario is like 145 on the S&P, 165, 166 on the, if it's the average thing. So where are you, Gabrielle? Will earnings disappoint, or will they be flat next year?
So, Joe, what we try to do is take the yield curve as one of the pieces of the broader puzzle that we look at. And what we see really is that there are pockets of strength and there are clear pockets of weakness as well. So when we put them together, our base case is still positive economic and earnings growth, but it's going to be incredibly, incredibly moderate. And it's also going to come with a lot of downside risk and volatility. But for earnings for next year, we're still expecting 3 to 5% positive earnings growth. So
that would put us at, what, about 170 or something? Where would that put us?
It's about 175.
175, and
that's
then
right. And then
what kind of multiple do we deserve? If we got these rates this low, we should be able to get 17.
So
16,
rates put a floor; they help. Otherwise, we would have had lower multiples. But the uncertainty also puts a cap. Right. We don't know how trade evolves. We don't know how it's going to impact.
Freaked out about it. Right.
So if we do, maybe 17 times does sound reasonable.
17
so
times.
Gabriela,
what's 17 times 175? What is that?
It gets you to around a little bit below 3,000 for the S&P 500.
But at 17 times, we're still below where we were in January of 2018. We were above 19. So.
That's the recession concerns that are playing in. Like, okay, we see it right now, but what's going to happen a quarter?
Paul, do you have comments?
Yes, so I mean, I think what you're looking at is, as Gabrielle was saying, the uncertainty puts a cap on things. Our two biggest concerns throughout most of this year have been uncertainty and the yield curve. And what Mike was telling before, the yield curve isn't just a switch that turns things on. And as Joe was saying, we have to watch the credit markets. We have to watch signals in the market. We have to watch as close to real-time indicators of the economy as we can. Jobless claims haven't seen any sort of spike. They're being right at generational lows. And on this low interest rates, as we see rates come in, what you have to remember is that it's very stimulative for the consumer and for businesses. The average mortgage payment would be down based on where it was prior to the year. It's down by over 15% year to date. Borrowing costs are down by over 100 basis points for corporations. So those kind of moves are stimulative. And when you've seen big moves in the Treasury market, like we've seen this year. Actually, it's the strongest year since at least 1987 for Treasuries. For the remainder of the year, equities have every time we've been up at least 15% in Treasuries, we've seen gains for the remainder of the year in the equity market. So I think that you have to weigh the pros and the cons, as we always try and do. And the pros are still outweighing the cons by a little bit, but the yield curve and uncertainty are certainly things that are capping.
I mean, Terranova, how do you know that the bond market doesn't have a better feel for what happens with the trade war than the rest of us? I mean, we haven't seen the worst case scenario for the consumer or for import price. None of that stuff have we seen the Armageddon that a lot of people were either hoping for or talking about. Maybe the bond market sees that China, that this is not going to turn out well. Is that possible?
The consumer is far more relevant to the story here in the U.S.
So you don't worry the trade war could really get out of hand?
I worry about the trade war. I worry about the messaging of
in
the trade
terms of
war.
the economy, in terms of uncertainty, in terms of people pulling in.
Joe, it's already
because you can talk yourself into a recession.
It's impacting manufacturing. It's unquestionably it is impacting manufacturing.
I think we're entering a different phase of these trade tensions with this next round of tariffs, which are going to start impacting consumer goods. And the issue is more that we've never been here before, and we don't know exactly what the tipping point is. Eventually, when it starts impacting business and consumer confidence so much that it starts impacting that 70% of the economy that's the consumer.
And my thought on it is that it was never about consumers having to pay more at retail. It was about, does this tip the world into a real pronounced slowdown? So if it's a hard landing in China, emerging market currencies are at their lows.
Yep.
Right? That index is at the lows. It creates the conditions for more of a global financial accident. It's not about the frictional cost of absorbing the tariff.
That's an excellent point, because that means even if we win the trade war and inflict more pain on the Chinese than on ourselves, we lose, because it comes back to our shores eventually anyway.
Right, maybe lose less, but it's not a great environment for S&P 500 multinational companies trying to make profits around the world.
There was a very interesting interview yesterday, I think, on Squawk on the Street, with the Hasbro CEO, who talked about how they have been moving their operations out of China. They're very happy that they've been able to do that, but they're down from 90% of manufacturing in China back in 2012 to about two-thirds.
I saw that.
Today.
They're asset light there. They didn't own a single factory over there.
Right.
They're able to do it.
They're able to do it, but it's taking them 7 years to get to the point where they're down from 90% down to two-thirds. By next year, they're hoping to be down to about 50% of production there. But this is not something that can happen overnight. They've been doing this for 7 years.
And I will say toys is a pretty specific case. In other words, it's very much dominated by Chinese production.
Yeah.
And also, that toys don't exactly have pricing power. This is not a category that's been growing in a very strong way. Well, yeah.
Even today, the reports, though, Google's going to move the production of the Pixel out of China and into Vietnam. So, but that stuff is going to take a lot of time.
That's the point. You can see that, okay, there is a way that you can do it. They've even brought Play-Doh back here to the United States, but it doesn't happen overnight.
And it costs a lot of money.
And they're still going to be impacted by the trade tariffs right now for the holidays.
Right. So, I think what you have to look at is here, we've seen a lot of headlines over the last several weeks about tariffs, no tariffs, the tweets from the president. But if you look, we've been in a range of 28.20 to 29.40 ever since August 2nd. Yep. We had this from August 9th to August 19th. We were down 1.2%, up 1.2%, down 2%, up 2%, down 4%, up 4%. So it's a lot of just, noise at this point. And I think once you see the market break out of a range either way, you're going to have more clarity as we get out of August and what's the deadest time of year for the markets.
If it matters tactically, that activity and all this news flow has gotten sentiment, I think, pretty cautious and pessimistic right now, and investors are kind of braced for something worse. So that, on a net basis, that can be a good thing if the worst doesn't happen.
Yeah, at that point, Sunday night, everyone you talk to, how much is the market going to be down on Monday? And we were up 1% at the end of the day. So I think there's quite a bit of fear in the markets.